So the Fed paused its 15-month-long rate hike campaign, but the dot plot tells the real story, or does it? The central bank's rate projection suggests 2 more increases this year as Chair Jay Powell highlighted persistent inflation and labor market strength.
The conditions that we need to see in place to get inflation down are coming into place, and that would be growth meaningfully below trend. It would be a labor market that's loosening. It would be goods pipelines getting healthier and healthier and that kind of thing. The things are in place that we need to see, but the process of that actually working on inflation is going to take some time. It will be appropriate to cut rates at such time as inflation is coming down really significantly. And again, we're talking about a couple years out. I think, as anyone can see, not a single person on the committee wrote down a rate cut this year, nor do I think it is at all likely to be appropriate.
Joining us now is Chris Versace, Tematica Research Chief Investment Officer. Chris, good to talk to you this morning. So the one clear point that the Fed chair made is that there's no rate cuts this year. And yet there seems to be some mixed messaging in terms of those additional rate hikes that could come. What do you make of the dots?
So you have to remember that this kind of came out, I think, as Julie said, in the economic forecast. And forecasts, we know, can change depending on what the most recent data has to show. And we're going to continue to get a lot of data. We've actually been thinking that for a long time now, no rate cuts were going to be had this year. So that's not really surprising to us. I think what jumped out, though, is what the Fed did with its GDP forecast for this year, where it raised it from 0.4% to 1%. That kind of tells you the economy is holding up better than expected. So it stands to reason that their fight on inflation might go a little bit longer. But in just the video we were watching, though, it was funny to watch, though, because Powell was like, well, rate cuts will be, several years out. But if you look at their own forecast, they're going to go from 5.6% Fed funds rate to 4.6% by the end of 2024. So they are coming at some point. And I think a lot of this is kind of catching the market off guard. Right? Clearly, it did not expect the notion that there might be more rate hikes coming. But now we've got to digest this other data, too. And to me, I think we'll hopefully get a little more clarity later today when a couple Fed heads, as I like to call them, make the rounds. I believe Waller and then another gentleman is actually speaking later today.
What grade would you give Jay Powell on his performance yesterday? I mean, listen, no matter what he says, like people come out of the woodwork criticizing him from both sides of the spectrum, saying, oh, well, they should be done hiking entirely, to they should have hiked yesterday and should be continuing to hike. What do you think?
So I'll start off by saying that is not a job I would want ever. But again, when you look at the data and you look at the Fed's 2% target, core CPI, yes, it ticked down to 5.3% in May, but wow, that is such a distance from 2%. You look at the core PCE price index, still a distance from 2%. So, it stands to reason there is more work to be done. And I think we're at the point now where they're going to start really fine-tuning at the edges their policy. And I think that's probably what they were really trying to communicate. Maybe we have one. Maybe we have 2 more. We'll be data dependent and see.
Is 2% part of the problem? Do they need to change that target?
This mythical 2%?
Yeah.
I mean, it very well could be. What's wrong? You've heard people say this. What's wrong with 2.5%? What's wrong with 3%? There are structural changes that have unfolded in the economy that perhaps that is warranted revisiting.
This comes at a time when there's a lot of questions about whether, in fact, the Fed has a very good grasp on inflation. And I wonder when you hear... You
mean from these guys who said, oh, don't worry, it's transitory?
Exactly. I mean, we're talking going into last year, right? So, to what extent do you think the Fed's credibility is in question here? And when you think about what we heard from Jay Powell yesterday, does that point to the fact that they're a little behind the ball?
They are a little behind the ball, but I think when you look at what's unfolding in the data, I think everybody expected it to fall faster than it really has. So you have to step back and ask, what's different this time around? What's structurally different? And as we do that, you could look at what's going on in the employment market without question, whether it's minimum wage pressures, ticking higher over the last few years, or the tight labor market, what we're seeing in the housing market. You take a look at what Lennar said this morning, and they're seeing demand pick back up again. So that fight on shelter inflation might be a little longer in the tooth. And I think when you step back, it says that everything the Fed has done thus far has not cooled the economy to the extent that they thought it would. So more needs to be done.
Or maybe they can't.
Or maybe they can't.
Right? Maybe the tools that they have are not the tools to address the structural changes that you're talking about. And I mean, I don't know what the answer to this question is.
And then it becomes a question of to what extent the Fed can control this, right? I mean,
Exactly.
has been part of the conversation.
So if you remember the start of all of this with the supply chains and coming out of the pandemic, those were a lot of supply chain issues. And the Fed was very clear, look, we have demand-driven tools. Right. That's all we can do is blunt demand. So it looks like they're going to have to do more of that. And, you know, if you go back a couple Fed meetings, Powell was like, look, there's going to be some pain. And it's just not showing up yet.
Or at least not enough.
Correct.
Yeah.